Imagine waking up tomorrow morning, grabbing your phone, and seeing a notification that makes your blood run cold. All banking services suspended indefinitely. You rush to the ATM. It's dark. You try to pay for coffee with your card. Declined. You open your banking app. Error message. In less than 24 hours, the money you thought was sitting safely in your account has become inaccessible. Not gone, just locked away. And here's what nobody tells you. This scenario isn't some far-fetched dystopian fantasy. It's happened before. Multiple times. And the systems we've built to prevent it? They might be creating the conditions for it to happen again. But worse. Much worse. Stay with me, because what I'm about to show you will change how you think about every dollar in your bank account. To understand what would really happen if banks closed tomorrow, we need to talk about something most people fundamentally misunderstand about banking. Your money isn't actually in the bank. Right now, you might think you have, say, $5,000 in your checking account. But here's the reality. The bank doesn't have $5,000 with your name on it sitting in a vault. They have a digital record that says you're entitled to $5,000. But that physical cash? The bank lent most of it out the moment you deposited it. This is called fractional reserve banking, and it's been the foundation of modern finance for centuries. Banks only keep a fraction, typically around 10%, of deposits on hand. The rest gets loaned out to other people, who deposit it in banks, who loan it out again. $100 in actual cash can become $1,000 in recorded deposits through this multiplying effect. It's financial alchemy, and when it works, it powers economic growth. But when it fails, everything collapses at once. The system runs on one thing: trust. Trust that when you want your money, the bank will have it. Trust that other depositors won't panic and withdraw everything at once. Trust that the bank made good loans that will be paid back. Remove that trust, and you don't have a banking system anymore. You have a powder keg. And history shows us exactly what lights the fuse. Let's go back to December 1930. The Bank of United States, despite its official-sounding name, just a private commercial bank in New York, suddenly failed. Over 400,000 depositors lost their savings overnight. Not because the bank was criminal or reckless by the standards of the time, but simply because too many people wanted their money at once, and the bank, like all banks, didn't actually have it. This single failure triggered something catastrophic. Other depositors at other banks heard the news and thought, what if my bank fails too? So they rushed to withdraw their money, which caused those banks to fail, which caused more panic, which caused more withdrawals. By 1933, over 9,000 banks had collapsed. 9,000. Millions of Americans lost everything they had. Not because of war or natural disaster, but because of a loss of confidence that fed on itself like a financial wildfire. The government's response was to create the Federal Deposit Insurance Corporation in 1933. The FDIC would guarantee deposits up to a certain amount, so even if a bank failed, depositors would get their money back. The logic was simple. If people know their money is safe, they won't panic and cause bank runs. And for decades, this seemed to work. Fast forward to the 2000s. Banking had evolved far beyond the simple model of deposits and loans. Banks were now interconnected through complex financial instruments that even experts struggled to understand. They traded mortgage-backed securities, credit default swaps, and derivatives that created chains of dependency spanning the entire global financial system. If one major bank failed, it wouldn't just hurt its depositors. It could trigger a cascade that brought down dozens of other institutions. In 2008, we saw exactly this happen. Lehman Brothers collapsed in September, and within days, the entire global financial system was on the brink of total meltdown. ATMs were hours away from running out of cash. Credit markets froze. Banks stopped trusting each other. The money that existed as digital records in computers suddenly became questionable. Was it real? Would it be there tomorrow? The government responded with something unprecedented: massive bailouts. They injected trillions of dollars into the banking system, not to be generous to bankers, but because the alternative, letting the system collapse completely, was unthinkable. What would have happened if they hadn't? Every economic model suggested the same thing: a depression that would make the 1930s look mild. But here's where the story takes a dark turn. The fixes implemented after 2008, stricter regulations, stress tests, higher capital requirements, created a false sense of security. Banks got bigger, not smaller. The too big to fail problem got worse, not better. And in March 2023, we got a warning shot that most people missed. Silicon Valley Bank collapsed in less than 48 hours. It was the second largest bank failure in U.S. history. What caused it? Not bad loans or fraud, but social media. Depositors saw concerning news on Twitter and WhatsApp, and within hours, they had withdrawn billions of dollars through their phones. The digital bank run happened at the speed of information. By the time regulators realized what was happening, it was already over. 2 days later, Signature Bank failed. Then First Republic teetered on the edge. The government stepped in again, guaranteeing all deposits, even those above the FDIC limit, because they feared contagion. They feared the unthinkable, that trust in the banking system itself would evaporate and the entire structure would come down. So what would actually happen if banks closed tomorrow? Not one bank, but all of them simultaneously? Let's walk through the timeline. Hour 1, panic sets in. People try to withdraw cash from ATMs. The machines run dry within minutes in major cities. Credit and debit cards stop working. Digital payment systems fail because they all connect back to banks. Day 1. Grocery stores can't process transactions. Gas stations shut down. Anyone without physical cash can't buy food, water, or medicine. Businesses can't pay employees. Supply chains halt because truckers can't buy fuel. Week 1. Companies start failing. Without access to credit or the ability to process payments, businesses shut down. Unemployment explodes. People can't pay rent or mortgages, not because they don't have money, but because they can't access it or transfer it. Month 1. Social order begins to break down. People riot for food. The government attempts to distribute emergency supplies, but the logistics of feeding hundreds of millions of people without a functioning payment system proves nearly impossible. Barter systems emerge. The economy reverts to something resembling the medieval period. This isn't speculation. This is what economic models and historical parallels tell us would happen. The banking system isn't just a convenience. It's the circulatory system of modern civilization. Cut it off and everything dies. You might be thinking, surely there are safeguards? Backup systems? Emergency plans? There are, but they all have fatal flaws. The FDIC insures deposits, but it has nowhere near enough money to cover all deposits if multiple major banks failed simultaneously. It's a confidence game. It works only if most banks stay healthy. Central banks can create emergency money, but they can only help banks that are solvent but illiquid. If the entire system loses trust, printing money just accelerates the collapse into hyperinflation. Digital currencies and cryptocurrencies are touted as alternatives, but they require internet infrastructure, electricity, and most importantly, vendors willing to accept them. In a real crisis, people want food and water, not Bitcoin. The truth nobody wants to admit: there is no foolproof solution. The banking system is built on trust, and trust, once lost, is nearly impossible to restore quickly. Now here's what should terrify you. The conditions for a banking collapse are more present today than they've been since 2008. The Federal Reserve raised interest rates faster than any time in modern history to fight inflation. This means banks are sitting on huge losses in their bond portfolios. Many banks are technically insolvent if they had to sell these assets at current market prices. Add to this the consolidation of banking. The top 4 banks in America now control over 40% of all deposits. In 1990, they controlled 10%. We've created a system where fewer, larger institutions hold more risk. The too big to fail problem is now too big to save. And there's something new: the speed of digital bank runs. In 1930, a bank run took days or weeks. In 2008, it took days. In 2023, Silicon Valley Bank collapsed in under 48 hours. The next crisis will happen at the speed of social media. Panic will spread globally in minutes. Withdrawals will happen through phone apps faster than regulators can respond. Here's the data that should keep you up at night. As of 2024, U.S. banks held over $620 billion in unrealized losses. That's money that exists on paper, but would evaporate if banks were forced to sell assets. Meanwhile, commercial real estate is collapsing as offices sit empty. Regional banks are particularly exposed. The dominoes are lined up. We're just waiting for something to tip the first one. So what do you need to understand from all of this? First, your money in the bank is not money, it's a promise. A promise that works only as long as everyone believes it works. The system is built on collective belief, not tangible assets. Understanding this fundamentally changes how you should think about financial security. Second, the modern financial system is more fragile, not less. All the regulations and safeguards created after 2008 have made the system more complex, more interconnected, and more dependent on trust. When trust breaks in a complex system, it breaks catastrophically. Speed and complexity are now the enemy. Third, diversification isn't just about stocks and bonds anymore. It's about having some assets outside the banking system entirely. Not because banks will definitely fail, but because the cost of being wrong is too high. Physical cash for emergencies. Tangible assets. Multiple banks. Different types of accounts. These aren't signs of paranoia. They're basic risk management in a system built on faith. Here's the question I'll leave you with. What happens when the generation that remembers the Great Depression is gone? When nobody living has experienced a true banking collapse? Does the system become safer? Or do we simply forget to be cautious? We're living in the longest period without a major banking panic in American history. That's either a sign that we've finally figured it out, or that we're due for a reminder of what happens when trust evaporates. History suggests the latter. The pattern repeats. Stability breeds complacency. Complacency breeds risk-taking. Risk-taking breeds crisis. The banks might not close tomorrow. They probably won't. But the fact that you couldn't really survive if they did, that should tell you something about how dependent we've become on a system that's far more fragile than it appears. If this video changed how you think about money and banking, hit that like button and subscribe for more deep dives into the financial systems that run our world. Drop a comment below. How much cash do you keep on hand for emergencies? Are you prepared for even a week without access to banks? Let's talk about it. And check out my video on the history of bank runs. The link is in the description. The patterns from the past might just predict our future. Thanks for watching, and I'll see you in the next one.